More than $6 trillion vanished in about an hour. Gold went from around 5,600 to near 5,100, like the floor opened underneath it. Silver snapped from roughly 121 down to about 108, so fast your stop loss didn't trigger. It got jumped. If you bought the top with leverage, you didn't take a loss. You got introduced to the liquidation machine. And here's the part that should bother you. This wasn't a random bad day. This wasn't the metals suddenly failing. This was a familiar pattern, executed with precision, and most people still don't know what actually pushed the first domino. Because when the first domino falls, everything else is automatic. One margin call becomes 10, 10 become 100, 100 become forced selling across anything that can be sold. And in that chaos, the only people calm are the ones who positioned before the candle printed. Today wasn't just a crash, it was a transfer. In this video, I'm going to show you the hidden lever that crushed both gold and silver at the same time, why it creates these waterfall candles, and why the same setup has already produced a monster reversal before. And yes, before we're done, I'm going to put a specific call on the record with a specific date. If you click away before that, you'll miss the one part that turns panic into a plan. Quick intro, then we get right into it. If you're new here, I break down market moves in plain English, without the sugar, so you can stop reacting and start anticipating. Subscribe. Short. Simple. Because this exact sequence will happen again, and next time you want to recognize it while it's forming, not after your account is smoking. Now, what happened? On January 29, 2026, around mid-morning Eastern Time, gold was trading near 5,600 per ounce. Silver was trading around 121. About 60 minutes later, gold printed near 5,100. Silver printed near 108. That's roughly $500 wiped off gold and roughly $13 wiped off silver in the time it takes most people to make coffee and open their charts. Here's what that looks like in real life. If you had $100,000 in silver at the high, you just watched it become about 89,000 without doing anything wrong except being on the wrong side of speed. If you were leveraged, you didn't watch. You were removed. The platform didn't care about your thesis. The broker didn't care about your long-term view. A liquidation is not an opinion. It's a button the system presses when your collateral can't survive the candle. This is why these moves feel personal. They aren't. They're mechanical. And that's why they keep repeating. So let's talk about the engine behind the waterfall. Forced selling. When price drops fast, margin traders get calls. They must post more money or close positions. Most can't post more, so they sell. Their selling pushes price lower. Lower price triggers more margin calls. More margin calls create more selling. And now you have a cascade where the market is no longer trading, it's flushing. That flush is why you see the candle go vertical. It's why silver especially looks like it falls through trapdoors. Silver is the thin ice of the metals complex. It moves faster up and it moves faster down. Now here's the first critical point. Gold and silver didn't collapse because their story died in 1 hour. They collapsed because something else moved first. Something bigger. Something most retail investors don't even watch. It has a boring name, and it ruins people who ignore it. The DXY, the dollar index. If you learn one thing from this entire breakdown, learn this. Gold and silver are not just traded on their own charts. They're traded against the dollar. Metals are priced in dollars. So when the dollar suddenly surges, it creates pressure on the price of metals, fast. Think of a seesaw. The dollar is on one side, gold and silver sit on the other. When the dollar side pops up, the metal side drops. When the dollar falls, the metal side rises. This isn't a cute metaphor. It's the math of how pricing works. A stronger dollar means it takes fewer dollars to buy the same ounce, so the dollar price of the ounce falls. A weaker dollar means it takes more dollars to buy the same ounce, so the price rises. Today, the seesaw snapped upward on the dollar side, and metals got slammed. Not because everyone decided gold is bad, because the currency the world uses to price gold suddenly got more expensive. And here's what separates professionals from tourists. Tourists stare at the gold chart and scream, "Manipulation," when they get blindsided. Professionals stare at the dollar, the rate market, and positioning, and they see the move before the metals even react. By the time the red candle shows up on your metal chart, the big money has already shifted, and retail becomes the exit. That's the ugly truth. So why did the dollar surge today? 3 forces hit at once: Each one matters. And when they stack, they don't create a dip, they create a trapdoor. Reason 1. The Federal Reserve tone. The market has been leaning on a fantasy: fast cuts, easy money, smooth sailing. But the Fed has been signaling higher for longer. That's the hawkish posture. Hawkish means they're willing to keep rates high, even if markets complain. High rates make the dollar attractive, because yield matters. If you can earn more holding dollar-denominated assets, global money flows into dollars. Euros convert, yen convert, pounds convert. Demand for dollars rises, the DXY rises. And metals feel it immediately. Because metals don't pay yield. They're the anti-yield asset. When the market starts believing rates stay elevated, it tilts toward the dollar. And that tilt is pressure on gold and silver. Reason 2. China growth fear. This one hits silver like a hammer. Because silver isn't only a precious metal, it's an industrial metal with a shiny suit. A huge chunk of demand is industrial: electronics, solar, EV supply chains, manufacturing. When China's industrial pulse slows, the market starts pricing less demand. Even if it's temporary, even if it's headline-driven. Traders don't wait for the long report, they hit sell. And silver reacts harder than gold because it's more sensitive, more volatile, and more tied to industrial narratives. That's why you often see silver overreact. It's not polite, it's a multiplier. Reason 3. Political uncertainty and risk reduction. There's a shutdown deadline hanging over the US government around January 31st. Markets hate uncertainty. Not because they're moral, because uncertainty increases the probability of surprise. And when surprise risk rises, funds reduce exposure. They take profits. They de-risk. They raise cash. And after a big run, traders are sitting on gains they're itching to lock in. So when a fear headline appears, it becomes the excuse. Not always the true cause, but the trigger. Stack these three together: hawkish rate expectations, China slowdown fear, shutdown uncertainty. Now add the catalyst underneath all of it: a dollar spike. And you get what we saw: a macro flush. Both gold and silver down together. Fast, violent, no mercy. Now here's where most people misunderstand the relationship between gold and silver. They assume they move the same way, with the same force. They don't. Gold moves. Silver amplifies. Silver is gold with leverage baked into its personality. When gold rallies, silver often rallies harder. When gold dumps, silver often dumps harder. That's the nature of a thinner market and a more emotional crowd. So yes, gold dropping about 9% and silver dropping about 11% fits the pattern. But notice the key detail. Today wasn't a silver-only event. Today was both metals moving together. When that happens, it screams macro. It points back to the dollar and rates. Compare that to days where silver collapses and gold barely flinches. Those are typically industrial demand fears, positioning squeezes, or silver-specific liquidity events. Today was bigger. Today was the whole complex getting hit by the same wave. Now here's the part that should wake you up. This exact timing has shown up before. Not years ago, recently. End of December 2025. Last 2 trading days of the year. Same vibe. Sharp sell-off. Panic. Liquidations. People declaring the bull market dead. Comment sections full of doom. And then January happened. Gold ripped. Silver went nuclear. New highs. Massive monthly gains. A lot of people sold the low and watched the rocket leave without them. That's why today matters. Because today looks like a rhyme. Not a guarantee, a rhyme. And if you can recognize the rhyme while it's forming, you stop being the person donating money during the flush. So the question is obvious. Is this crash the end? Or is it the reset before the next leg up? Before we talk scenarios, we need to anchor one truth. A crash can change price, but it doesn't automatically change reality. Sentiment can swing in 60 minutes. Supply chains don't. Monetary policy trends don't flip because your chart turned red. Geopolitical currency shifts don't reverse because traders puked positions. So you separate two things: the short-term mechanics and the long-term forces. Today was mechanics plus a macro trigger. It doesn't automatically cancel the larger thesis people have on metals, but it does expose who was gambling versus who was positioned. Now let's talk about what comes next. There are 3 broad paths from here. Path 1. The bull trend resumes. Today becomes a shakeout. Weak hands are forced out. Overheated positioning cools down, and then buyers step back in once the dollar spike fades. In that scenario, February starts repairing damage quickly, and metals work their way back toward the highs. Path 2. More pain. The Fed stays hotter. The dollar keeps climbing. China headlines stay ugly. Risk assets wobble. Metals remain under pressure, and we see another leg down to test deeper support levels. Path 3. The grind. No heroic bounce. No immediate collapse. Just chop. Sideways torture. A market that bores people into quitting, and then it moves when most eyes have looked away. Which one is most likely? I'm not here to sell you certainty. I'm here to give you a framework. So here's the framework. Watch the dollar. If the DXY continues to rip upward, metals struggle. If the dollar rolls over, metals breathe again. And here's the twist. A lot of dollar strength is not new faith. It's positioning. It's short-term flows. It's rate expectations. Those can reverse quickly. And reversals are where the biggest candles are born. Now I'm going to put the call on the record. My view. Silver is back above 120 by February 15th. Not this year, not someday. By February 15th. Screenshot it. Hold me accountable. Why that date? Because it places the call on the other side of the immediate fear cycle. It gives time for the shutdown drama to either resolve or get priced. It gives time for the dollar spike to either confirm into a trend or fade back as a squeeze that burned itself out. And it aligns with how these flushes often behave in a bullish environment. Violent drop, emotional capitulation, then an equally violent repair. Does that mean there can't be more downside first? No, there could be. That's why you don't go all in on a single candle. But if you're asking me what I think the tape prints by mid-February, that's my call. Now I want your input because this matters. Do you think today was a final top or a shakeout before another run? And second question, be honest. Did you get stopped out or did you buy the fear? Drop it in the comments. I read them, and the answers tell you more about crowd psychology than any headline ever will. Now, practical advice, because theory without action is useless. If you hold physical metal, understand what you own. Physical is not a day trade. It's not a slot machine. It's insurance. It's a store of value you can hold outside the financial system. If you bought physical and you're watching minute candles, you're using the wrong tool for the job. Physical ownership doesn't change because spot printed a scary number. You still have the ounces. The screen doesn't take them away. So if you're holding physical for the long term, daily panic is optional. If you're trading paper with leverage, today was your warning label. Leverage in a volatile market is a deal with the liquidation machine. You think you're in control until you aren't. And when the market gaps, your stop loss is a suggestion, not a shield. The platform can liquidate you at the worst possible moment because it has to protect itself. That's why people blow up on days like today, not because they were wrong long-term, because they couldn't survive the path. If you insist on trading, reduce size, reduce leverage, or remove it entirely, because the market can stay irrational longer than your margin can stay alive. Now, for the people sitting in cash, staring at the carnage, this is where wealth is quietly built, not by chasing green candles, by buying when the crowd is traumatized. But do it like an adult. That means scaling, not going all in, buying in tranches. If it falls more, you have ammo. If it bounces, you're not left behind. And only deploy money you can hold through noise. Because if you buy with rent money, every dip feels like death. If you buy with patient capital, dips feel like discounts. Now to the people who bought the top. I'm not going to insult you. This market is designed to lure people at highs and terrify them at lows. That's what volatility is for. It's not a bug, it's a feature. So you have a choice. You can panic sell and make the loss permanent, or you can separate timing from thesis. Bad timing is painful. Bad investment is fatal. If your reasons for owning metals are still intact, your mistake may have been entry, not direction. And entries can be repaired with patience and strategy, but only if you don't hand your position to someone else at the bottom. Let me give you a reality check that helps with the emotion. Bull markets don't go up in straight lines. They punish belief with drawdowns. They shake conviction. They force you to ask, am I actually an investor, or am I just here for dopamine? In 2020, gold had a brutal drop and then ran to new highs later. In 2008, silver was demolished and later rallied hard. Corrections are part of the process. The question is whether you can hold your mind steady when the chart is trying to hypnotize you into dumb decisions. So what do we watch from here? 4 things. 1. The DXY. If it keeps climbing, be cautious. If it rolls over, be ready for a metal's snapback. 2. Rate messaging. Fed speakers. Anything that shifts expectations around cuts or higher for longer. 3. The shutdown deadline window. Even if it's political theater, markets trade theater. 4. China headlines and any shift toward stimulus or stabilization that changes industrial demand expectations. Those 4 inputs shape the next phase. Now let's zoom out to the bigger story hidden inside this crash. Days like today are when the market reveals its real purpose. It's a sorting mechanism. It sorts the impatient from the patient. It sorts the over-leveraged from the prepared. It sorts the people chasing certainty from the people building a process. $6 trillion didn't disappear. It changed hands. Someone sold in fear. Someone bought with a plan. That's the transfer. So ask yourself a hard question. When the next flush hits, and it will, are you the seller or the buyer? Are you reacting or anticipating? Because the market doesn't reward intelligence. It rewards discipline. It rewards risk management. It rewards the person who can watch a red candle and not lose their identity. Now, if this breakdown helped you understand what happened, do 2 quick things. First, subscribe. Because the next time the dollar spikes and metals start sliding, I want you to see it early and not learn it after the fact. Second, share this with one person who is panicking right now. The person who is about to do something irreversible because the chart scared them. You don't fix a drawdown with hope. You fix it with understanding, patience, and a plan. And one more time, because repetition is how you survive these markets. Today was not random. Dollar strength plus rate expectations plus fear triggers equals a metals flush. The waterfall is mechanical. The panic is optional. The opportunity depends on whether you can think clearly while everyone else is melting down. So I'll end where we began. More than $6 trillion moved in an hour. A lot of people lost money. A few people positioned. February is coming fast. Will this be the end or the reset? Tell me in the comments, shakeout or top? And did you sell or did you buy? Either way, stay sharp. Because the market doesn't care about your feelings. But it does pay you when you learn how it actually works.